How much worse can home prices possibly get? The median age of a first-time homebuyer is now approaching 40, not even accounting for the people who will never buy a house. 1% down mortgages are becoming increasingly common, and so are 40-year loan terms. The median family now needs to spend almost 40% of their income just to cover the median loan repayment. And that's before counting income taxes and other expenses like insurance, property taxes, and maintenance. In certain cities, this number is over 90%. Which effectively means the average family cannot afford the average home. For most people, the only feasible way to buy a house today is to have already sold a house. First-time buyers now represent the smallest share of the market since economists started collecting this data more than 4 decades ago. The numbers are not great, but at least they seem to suggest affordability can't get any worse, right? Well, unfortunately, there are several emerging factors that can make home prices much worse.
In 3 years since graduating from college, 25-year-old Zoe Zarenda is back in her childhood bedroom in Connecticut.
40% of those in multi-generational homes cite financials as the reason for cohabitating.
But the bank of mom and dad is playing a bigger role in buying houses.
It's becoming difficult as major insurance companies pull some of their coverage options.
It means I have to work extremely hard to be able to afford a nice house one day.
Now, before we get into completely crushing everyone's hopes and dreams, there is at least some good news. The median sales price of homes in America over the last 3 years has actually trended downward slightly from its all-time peak in 2022. A lot of people point to this as a sign that housing construction initiatives and affordability policies might finally be starting to work. But there's an important detail about this data. The median sales price only tracks homes that actually get sold, and the number of homes being sold has dropped significantly. According to the National Association of Realtors, there are now almost 25% fewer homes being sold each month than before the pandemic, and almost 40% fewer than just 4 years ago. You probably already know one of the main reasons why. People who locked in mortgage rates below 3% a few years ago are extremely reluctant to sell their homes. Even if they move to another city, many of them prefer to rent out their current property rather than sell it and lose that low interest rate. This trend has become a major force shaping the housing market. Another reason the median price can look misleading is the type of homes being sold. People forced to sell are often those with lower incomes, and the homes buyers can still afford tend to be smaller starter homes. Indexes that adjust for these factors, like the Case-Shiller Home Price Index, still show that prices are rising steadily year over year. But even with that nuance, there are levels to this housing crisis.
Mortgage rates have now risen up above 5% for the first time in a long time, and home prices have also been rising.
If you look at predictions of where mortgage rates may be, say, 2 or 3 years from now, most people are looking at interest rates to 7 to 7.5%.
And despite all the problems in the American housing market, we still have it relatively easy compared to many other countries. There are probably Canadians and Australians in the comments already saying Americans have no idea how bad things can get, and someone from London is probably telling them the same thing. But what many people don't realize is that there are housing markets even more unaffordable than those. In the hierarchy of global housing crises, the United States is still closer to level 1. So what would it take for us to move up to the next level? The first step would look like the housing markets in places like Canada, Australia, New Zealand, and certain high-income parts of Europe. In the United States, the average house price-to-income ratio is about 3.4. This metric roughly measures how many years of average household income it would take to buy the average home. It's not perfect, but it gives a useful comparison. In the United Kingdom, the ratio is about 8.7. In Australia, it's around 8.4. In Canada, it's roughly 9.5. If the US housing market moved toward these levels, average home prices could easily double or triple from where they are today. So how is that even possible? There are 4 major differences between these markets. The first difference is home size. Many international housing comparisons adjust homes to a standard size of about 90 square meters, or roughly 970 square feet. American homes are generally much larger. Instead of making housing more affordable by building smaller homes, we historically chose to build bigger houses. This is made worse by the fact that Americans traditionally share housing less than people in many other countries, although that is starting to change. Of course, it's not entirely fair to compare a large suburban house to a small studio apartment in a dense city, but even if Americans suddenly accepted smaller homes, prices could still rise significantly if certain economic trends continue. Another factor keeping housing somewhat manageable in the US is how geographically spread out the population is. Demographers measure this using something called urban primacy, which estimates how much of a country's population lives in its largest city. In the United States, about 7% of the population lives in the New York metropolitan area. That's still a huge number, but compared to many other countries, it's actually quite low. Even combining the 10 largest US metropolitan areas accounts for less than a quarter of the population. In countries like Australia, nearly half the population lives in just 2 cities, Sydney and Melbourne. When economic opportunity becomes concentrated in only a few locations, housing demand in those areas skyrockets. This leads to another phenomenon seen in places like London, Sydney, Vancouver, and Auckland. People work in expensive major cities to earn higher incomes, but since they cannot afford housing there, they buy property in smaller cities and rent it out. This strategy is known as rent vesting. It's becoming more common in the United States as well, especially after many homeowners locked in very low mortgage rates during the pandemic. As a result, housing pressure spreads from large economic centers into smaller cities where local incomes cannot compete, and economic activity in the U.S. is already becoming more concentrated. According to a report from the Bureau of Economic Analysis, just 31 counties account for more than 1/3 of the entire country's economic output. As industries like finance and technology continue to dominate, opportunities become concentrated in fewer locations. That pushes housing demand higher in those areas. In New York City, the most expensive housing market in the United States, the price of a modest 2-bedroom property is about 12 times the average disposable household income. That's already approaching the affordability levels seen in places like Sydney and Vancouver. But globally, things can get far worse. In cities like Beijing, Shanghai, Taipei, and Colombo, housing prices can approach 40 times average household income. That means someone would need to dedicate more than 30 years of their entire take-home income just to afford a small home.
Every percentage increase in a mortgage rate significantly increases the monthly payment, especially for low and moderate income families. So there are good reasons in the broader economy for raising rates, but this isn't good news for those trying to purchase a home.
If you come in with a lot of money down, it's easier to qualify for a mortgage. It's also less expensive to get a mortgage.
Something like 40% of families in America have no financial margin. They couldn't even afford a $400 medical bill or challenge. So the idea of being able to save a 20% down payment is almost unimaginable. And again, it goes back to the fact, worse than ever right now, is that food costs are going up, energy costs are going up, rents are skyrocketing so much faster than incomes right now. All of those get in the way of families being able to save for a down payment.
These cities are often left out of international affordability rankings because their average wages are lower, but the reality is that housing there is extraordinarily expensive relative to local incomes. So how do people afford it? Mostly by living in much smaller homes and pooling resources across multiple generations. The average American has roughly 900 square feet of living space per person. In dense Asian cities like Hong Kong, Shanghai, or Seoul, the figure is often between 170 and 300 square feet per person. Families combine savings across generations and live in very tight quarters while paying off enormous mortgages. Now, to be clear, the United States is still far away from this level of housing pressure, but assuming there is some natural limit to housing unaffordability is a dangerous mistake. If housing supply, lending policies, and urban development are not managed carefully, there is nothing stopping markets from moving in that direction. In fact, some early signs are already appearing. For the first time in more than 160 years, the number of people living in the average American household has started to increase. And that's happening despite declining birth rates. At the same time, average home sizes have begun to shrink for the first time in decades. It would be nice to believe this is happening because people want closer family relationships and more environmentally friendly housing. But the reality is much simpler. More people are sharing homes because they have to.